I know this sounds crazy, but I can't wait. I literally cannot wait for the next stock market crash. Not because I want to see people lose a lot of money and get sad and depressed. Not because I think I can predict when it's coming. No one can. But because every major crash in history has created the best buying opportunity. But only, and I really emphasize only for investors who are prepared for it. Now, again, that doesn't mean they know it's going to happen. It means they know emotionally that this is how they're supposed to respond. Morgan Housel is great, one of the best writers ever. He says, every past crash looks like an opportunity. Every future one feels like a risk. Spoiler alert, they're all opportunities. But of course, we see our stocks fall and we feel poor and it makes us feel sad and depressed. But today, I'm going to show you why downturns aren't something that disciplined investors fear. It's actually something they look forward to. When I say I can't wait for the next market crash, a lot of people in the comments get furious because they misunderstand what I mean. They think I'm saying that you should sit out and cash and wait. They think I'm saying that I want everybody to lose a lot of money. That's not the case. They think I'm saying you should try to time the market. Literally could not be furthest from the truth. In fact, doing nothing while waiting for a crash is one of the worst mistakes an investor can make. You're not Warren Buffett. You don't have $500 billion in permanent capital. You don't get paid massively to wait in short-term treasuries. And the reality is, most people who say they're waiting for a crash end up missing years of compounding. The truth is this: you need to be investing consistently at all times. Markets go up far more often than they go down. So if you're waiting for the perfect moment, you are going to miss the biggest days, which will literally kill your returns. I'm going to show you exactly how much a little later on, but that's why disciplined investors don't try to predict crashes. They prepare for them. Now, my situation, I want to remind everybody about my situation is because I've been sitting on cash for a long time. And a lot of people would say, well, Paul, you're sitting on cash. I'm not Warren Buffett, but I have more than I need. And 70% of my net worth is in real estate, apartment buildings. I have over 1,000 units, and businesses like Everything Money and other businesses that are growing every single day. That no matter where the stock market goes, they go up in value, they increase their cash flow. So if 30% of my net worth is in cash, which it's not, it's about 25%, it still allows me the opportunity to sit there and go, all right, I have 75% that's growing every single year, no matter what the stock market does. That situation is very different than most people. But I want you to prepare. And preparation looks very different from speculation. It means you're consistently investing through the ups and downs. You're building exposure over time, regardless of the headlines, whether they're euphoric as hell or they're depressing as hell. When markets get euphoric, you don't panic. You stay disciplined. The panic isn't, oh my God, I'm going to lose. It's, oh my God, I'm losing out. But fear will eventually show up. Prices will fall faster than fundamentals. I don't want you to freeze. I want you to be able to act and be smart about it. That's the difference between investors who survive a crash versus an investor who actually benefits from them. That's the true investor. So this video isn't about calling when the next downturn is going to happen. It's about showing you how to build a system that works before, during, and after it. So make sure to stick around because we're going to cover a lot, including what price I'd pay during the next crash for a stock we haven't covered in a long while. Guys, every crash feels so unique and so different when you're living through it. I've been through a few myself. The headlines are always new. The reasons sound more convincing and the fear starts to feel justified. But when you take a step back and you look at history, crashes all share the same pattern. Markets don't fall because the world ends. Guess what? The world is likely not going to end. And if it does end, who the hell cares about the stock market then? You might as well be investing at that point because your money's going to be worth nothing anyhow. Markets fall because expectations get far too high. Prices disconnect from reality and intrinsic value to a level that is unjustified. And eventually, something forces a reset. Eventually, the spark in the room filled with gasoline causes an explosion. We have seen this over and over again. Just in my lifetime, it was dot-com bubble in 2000, the housing and financial crisis of 2008, and the global pandemic in 2020. Just in the last 25 years, we've had 3 major crashes. And the funny part is, I hear people saying all the time, like, oh, crashes are so rare. 25 years, we had 3 of them. That's once every 8 years. Now, they're different triggers, but it's the same outcome. The analogy I always use is what I was mentioning before. In a room filled with gasoline, you don't know which spark will cause the explosion, but one of the sparks will eventually cause an explosion. That's something I got from John Hussman, and I think it's a great, great analogy. And guys, I promise you that one day in the future, we will see prices fall so sharply, and we will see fear absolutely take over, and investors will react emotionally. The same people today who are saying, oh my gosh, you're missing out on this AI boom, will be the same people in the future say you can't make money in stocks. Because in order to be this irrational on the upside, they're going to be this irrational on the downside. And that's when we will be here for support. I will be coming in every day with a massive smile on my face, telling you there are so many great opportunities out there. And guess what? At some point, people will say the same thing they're saying now, but on the flip side, Paul, you always say stocks are undervalued, but they don't go up at all. Okay, sorry, sounds good. Don't know what to tell you. I have no idea when it's going to turn. This is why I teach on YouTube, because I started to realize that we don't have a clue when things are going to happen. But for those of you who are disciplined to stick to a long-term process, I want you to be able to learn a long-term process that works in the long run. In the short run, it's not going to work. And I think that's evidenced by the fact that so many great value investors have not done well in the last few years. Michael Burry, who everybody criticizes now, saying, oh, he called 12 of the last 3 recessions. Yeah, he's called the market top several times and been wrong. I would still rather listen to Michael Burry than some pimply 19-year-old kid in his college dorm who has a picture of, who are the hot chicks these days? What's the name? One that was married to, that was dating Machine Gun Kelly, Cleveland's finest. What's her name? Megan Fox. Like, okay, great. I'd rather listen to Michael Burry. I'm sorry. Now, one thing every market crash also has in common, the index has always recovered. The S&P 500, years, decades, everything later is always reaching new highs after a crash. So now the next question you need to be asking yourself is, what signs signal a crash may be coming? So to answer that question, let's talk about 2 different time periods, 1929 and 1999. What do those years have in common? First, major crashes followed, and a decade plus of zero returns. Second, 2 of the most reliable valuation metrics throughout history were at peak levels, and people were saying it didn't matter. Now, why is this so important for us at the beginning of 2026? I'm going to show you. Let's start with this. The Shiller PE ratio measures how expensive the stock market is by comparing today's price to the last 10 years of inflation-adjusted earnings. So it takes the last 10 years of earnings of the S&P, brings it to today, and divides the price by it. It's basically a 10-year PE. The average Shiller PE over the last century is 17. The absolute highest it's ever been in history was late 99 at 44x. In 1929, right before the Great Depression, it had its all-time high of 31 at the time. Where are we today? Now, before I answer that, I want to tell you that I do think the 17-year average will get higher and higher as time goes on because companies are a lot different today than they were 100 years ago. 100 years ago, in order to make money, you had to invest millions of dollars into factories, employees, and nowadays you can have a billion-dollar company with 3 employees. But currently, we're at 40.5, the second highest level ever. Now, let's not stop at that 10-year PE. What about the Buffett indicator? Warren Buffett's favorite metric for deciding whether or not the market is overpriced at any given time. Basically, what it does is it says, listen, the U.S. stock market is a piece of the U.S. GDP. As U.S. GDP gets bigger, the stock market should be bigger. Makes perfect sense. Now, excluding recent years, it reached its highest level of 150% in 1999, which meant that the U.S. stock market was 150% of the entire GDP. We're currently at 230%. The level of valuation we see right now is so far above any other time in history by a long shot. We are 130% overvalued. So like I started to mention earlier, some of the best days in the stock market happen right when you wouldn't expect it. And if you're sitting on the sidelines trying to time things perfectly, you will always miss them. According to a well-known study by JP Morgan, if you had invested $10,000 in the S&P 500 in 2004 and stayed fully invested through July of 2024, your return would have been about 10.5% annually, including dividends. That is real value creation. Now, what's interesting is in 2004, we were at pretty low levels of stock prices. In 2024, we're very high, and yet we were barely above the historical average of 9.5%, 10%. But if you missed just the 10 best days during that period, your return drops to 6.2%. That's a massive difference. If you miss the 20 best days, it falls to a horrendous 3.6%. Now, That's no small difference, missing the best 10 or 20 days out of the thousands. I will say this. The thing I don't like about that stat when people say it, and every financial advisor in the world says it, I say, but yeah, if they're missing the 10 or 20 best days, they're also missing the 10 or 20 worst days as well. So the real stat should be, hey, if you take those out, what are you missing? Even then, the point is you cannot guess when the best days and worst days are going to happen. That's why trying to jump in and out of the market is so damaging. You have to sit there and stay invested because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. You're not going to know when that best day is going to occur, and you don't know when that worst day is going to occur. That's why disciplined investors stay invested. Not because they're reckless, not because they're ignoring the risk, but because they understand how markets actually behave. Unless, and this is not the group that's watching these videos, unless you're independently wealthy and you don't need to make any more money. In that point, you might be in the capital preservation part of your life. You know, we have a lot of real estate. We did a new apartment build with a billionaire family in Ohio. And their comment to us was, we just want to stay billionaires. As long as we make 4 or 5%, we are happy. Now, obviously, they want to make more than that. And the real estate deals we do with them make far more than 4 or 5%. But look at that mentality difference. They're not trying to build massive wealth. They're like, listen, we have enough. We don't need more. We just want to make sure our money keeps on growing responsibly. You've got to remember, in periods of volatility, your best move is often no move at all. That's very hard for people to do when it comes to anything in life. So guys, what strategy should you actually deploy? I was listening to a talk by Monish Prabrai a few days ago. Guys, a few years ago, we flew out to Austin, Texas, went to his office, met Monish, interviewed him, had a great conversation with him, and we had tacos with him. He's a great guy. In this video I watched, he proposed a 2-part strategy for new investors starting today. First part, very simple. Get a job that pays you well and set aside a piece of your income every month to buy either the S&P or Berkshire Hathaway. I like Berkshire. I'd still rather just buy the S&P. This ensures you're always invested. You're capturing the long-term growth of a diversified set of businesses, and you're letting compounding do its job over decades. The only reason to not do this is you don't believe the US will be a much better and bigger country 20, 30, 40 years from now. That's the foundation. The second part is where crashes become powerful. On top of that steady investing, Monish would look for select individual opportunity, moments when fear or panic causes high-quality businesses to trade well below their intrinsic value. This is not something you should expect to happen every day or every week. Monish says that if you can find 2 or 3 opportunities a year where price becomes so disconnected from value, it would massively change your long-term results. But guys, for that to happen, you have to have the discipline to be able to look at them and say the market is wrong. And that's very difficult when all your friends are out there saying blah, 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 blah. This is the key distinction that most investors miss. You don't abandon your core strategy to chase the opportunity. You layer those special opportunities on top of the disciplined approach. But this only works if you're prepared before stocks fall. You need to know which companies you want to own, and you need to know the price you're willing to pay for them. That's what value investors like Monish, like Buffett, like Munger, and the things like I focus on. Hope is not a plan. I used to buy stocks hoping that they would go up, but hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the stock analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. This is where everything really comes together. I want to show you guys exactly how you can use part 2 of the strategy Monish just described. So to start, price is easy. Price is what you see on your screen. You look up Microsoft stock, that's the price. It moves every millisecond, and it moves without you caring at all. Value is much harder. Value is what a business is actually worth based on the cash it can generate over its remaining life. And here's the key insight. Price and value rarely line up in the short run, but in the long run, they move in tandem. That means if you can find companies where price is so disconnected from value and be patient, you can achieve higher returns. But this only works if you understand what you're buying. If you don't know how a company makes money, how stable its cash flows are, how much debt it carries, or what could permanently damage the business, then a falling price isn't an opportunity. That's why hype can be so dangerous. Hype makes people buy businesses they don't understand at prices they never evaluated because all they're doing is chasing price. They're not looking for the gap between price and value. Disciplined investors do the opposite. They study businesses before the crash. They estimate what those businesses are worth using reasonable assumptions. So I want to show you guys how I analyze a company that's on my list of 30 stocks that I want to own forever. Guys, Visa is an incredible business. I think you'd be hard-pressed to find anybody who doesn't know what Visa is. And as the world becomes richer, as more and more people get bank accounts and do things, and think about how much of the world doesn't even use that yet, Visa will be the leader amongst them, right? So Visa, the price of Visa per share is $355. The market cap is $771 billion. That's taking all the shares outstanding and paying the market price currently for that. They generated $20 billion in free cash flow, $21 billion in free cash flow last year, net income of $20 billion. What I like is Visa's free cash flow over the last 1 and 5 years is higher than their net income. Why is that good? Because most people focus on this, but free cash flow is the lifeblood of the business. So if you can buy a business where people are all focused on the net income, but the free cash flow is better, you're going to have an advantage there. Now, returns on capital, really high. It means Visa's great at managing and handling the money in their bit. They're very efficient at it. And if they have investment opportunities, they get very high returns on that. Look at this. 80% gross margin, 50% bottom line margin. This company prints money. They pay dividends, $4.6 billion a year, which they can afford, but because of how valuable the company is, it's only a 0.6% dividend yield. And guys, growth rates. 11% a year for the last 3 years, 12% a year for the last 5, 11% for the last 10. Not price growth, revenue growth rates. Okay, let's go look at our 8 pillars here. 6 checks, 2 X's, and those 2 X's are valuation. But remember, guys, an X doesn't mean it's not a buy. It just means, hey, this seems overpriced, go see if it's justified. Because remember, if a company is selling for 40 times free cash flow, but it's going to double its profit every year for the next 20 years, I would pay 400 times free cash flow to own it because it's going to grow so fast. That's the key here. It's not just about what it's selling for in terms of a ratio. It's about what's that future look like. And that's really important. Now, guys, if you're new to the channel and this feels overwhelming, you're not alone. It's been overwhelming for everybody in history at some point. The question is, are you here to learn or are you here too scared to learn? I'm here to simplify all of this for you. I show you guys all these metrics here, and I want you to have that readily available. So I created a cheat sheet for you. It explains all of these metrics to you, why they're important, what they do, and the worst case scenario, guys, is you're going to sound a lot smarter to your friends, and your friends are going to give you a lot less bullshit. So if you're interested in this, click the link below. We will email you this PDF very quickly. You'll have it absolutely free of charge. So what do the analysts think about Visa? Well, earnings per share, pretty solid, 13, 14, almost $17, double-digit growth every year. What about revenue? Double-digit growth. I'm actually surprised it only goes 3 years out, 2 years out. Guys, Visa's a great business, and it's a premium company. So we have this. We have a story. We have the numbers. Let's pull up our stock analyzer tool to put it all together. The stock analyzer allows us to make assumptions about the future. I'm making assumptions about 10 years out and say, what's the right price to pay today based on those assumptions? Now, I'm going to alter mine slightly. I'm going to do 5, 8, and 11% revenue growth. Now, you might sit there and say, well, Paul, everybody thinks it's going to be double digits. Yeah, we've also been in a booming economy. We've also had really good times. There's going to be some ups and downs along the way. So I'm going to be a little more conservative. Profit margin. Their profit margin in the last 5 years was 52%. Look at this free cash flow. I'm going to focus on free cash flow. I actually might be low here. I did 50, 53, and 56 for both of these. Now, what PE should I pay for Visa 10 years from now? Now, guys, this is where it gets tough. Because if somebody Warren Buffett bought Coca-Cola. Warren Buffett bought Coca-Cola for 30 times earnings in 1987 and still made 12% of his money. Do I believe that's the right move? No. Do I believe Visa deserves a really high valuation? If the market average is 15 to 16, I put in 20, 24, and 28 times earnings. That's a big number, but it makes sense to me. And finally, I did my 9% market return to just say, what's the intrinsic value? Not what I'm willing to pay for, because I need margin of safety. How do I get margin of safety? I increase my desired return to a much higher number. But either way, I sit here, made my assumptions, hit the analyze button. The stock's currently at 355. Low price of around 200, high price of 450, middle price of 300. Now, I have in my watch list at 230, but I'm going to change that to 300, not because I'm going to buy it at 300, because I want to do more research and then buy cash secured puts on that. All right, guys, so I want you to remember that at the end of the day, investing does not reward emotional excitement. It rewards discipline. Hype pulls people in at the top, panic pushes them out at the bottom, and the impatience destroys compounding. The investors who win are the ones who stay focused, understand what they own, and wait for price to give them an advantage. You don't need to predict crashes. You don't need to chase the next big thing. You need a plan, you need patience, and you need the courage to act when others will not. That's why I can't wait for the next market crash. Not because it's easy, but because that's when discipline finally gets rewarded. And guys, earlier last year, I picked 7 stocks that I thought would beat the Magnificent 7 over the next 5 or 10 years, going head to head. So click the video on your screen to see which 7 stocks I picked and how they stack up. The results might surprise you as much as they surprised me. Thank you for your time.